He will end us all. Michael Burry on why he hates Biden. Investor Michael Burry, made famous by the Big Short movie about his winning bets on housing collapse in the 2000s, is wagering on rising interest rates due to soaring inflation. Today we're going to talk all about what Michael Burry said about Biden and the inflation rate. So watch the video till the end, because today's video is going to be the bomb. Welcome to Michael Burry Secrets, your daily dose of Michael Burry. If you're interested in everything around Burry, this is the place for you. Subscribe if you want to stay updated with all the Michael Burry secrets, predictions, and stay one step ahead in the financial world. Watch the video till the end, and make sure to hit the like button if you want to be a millionaire within the next 3 years. Don't forget to enable all notifications to join our weekly cash giveaway pinned in the comments. Now let's get to our topic. The stock market has had quite a year. Plenty of cash is sloshing around, the pandemic recession notwithstanding, thanks to loose monetary policy, rampant inequality, crypto speculation, and helicopter drops of cash. Plenty of bored people are reading market rumors on the internet, pumping and dumping penny stocks, riding GameStop to the moon, and bidding up the price of esoteric currencies and digital artworks. The markets are swooning and hitting new highs as kitchen table investing, laptop on the couch investing really, is having a heyday not seen since the late 1990s. Yet economists, policymakers, and investors are worried that American markets have become inert, the product of a decades-long trend, not a months-long one. For millions of Americans, getting into the market no longer means picking stocks or hiring a portfolio manager to pick them for you. It means pushing money into an index fund, as offered by financial giants such as Vanguard, BlackRock, and State Street, otherwise known as the Big Three. With index funds, nobody's behind the scenes, dumping bad investments and selecting good ones. Nobody's making a bet on shorting Tesla or going long on Apple. Nobody's hedging Europe and plowing money into Vietnam. Nobody is doing much of anything at all. These funds are passively managed, in investor speak. They generally buy and sell stocks when those stocks enter or exit indices, such as the S&P 500, and size their holdings according to metrics such as market value. Index funds mirror the market, in other words, rather than trying to pick winners and losers within it. Thanks to their ultra-low fees and stellar long-term performance, these investment vehicles have soaked up more and more money since being developed by Vanguard's Jack Bogle in the 1970s. At first, Wall Street was skeptical that investors would accept making what the market made rather than betting on a market-beating return. But as of 2016, investors worldwide were pulling more than $300 billion a year out of actively managed funds and pushing more than $500 billion a year into index funds. Some $11 trillion is now invested in index funds, up from $2 trillion a decade ago. And as of 2019, more money is invested in passive funds than in active funds in the United States. Indexing has gone big, very big. For 9 in 10 companies on the S&P 500, their largest single shareholder is one of the big three. For many, the big indexers control 20% or more of their shares. Index funds now control 20 to 30% of the American equities market, if not more. Indexing has also gone small, very small. Although many financial institutions offer index funds to their clients, the big three controlled 80 or 90% of the market. The Harvard law professor John Coates has argued that in the near future, just 12 management professionals, meaning a dozen people, not a dozen management committees or firms, mind you, will likely have practical power over the majority of U.S. public companies. This financial revolution has been unquestionably good for the people lucky enough to have money to invest. They've gotten better returns for lower fees, as index funds shunt billions of dollars away from financial middlemen and toward regular families. Yet it has also moved the country toward a peculiar kind of financial oligarchy, one that might not be good for the economy as a whole. The problem in American finance right now is not that the public markets are overrun with falsons picking up stock tips on Reddit, investors gambling on art tokens, and rich people flooding cash into special purpose acquisition companies, or SPACs. The problem is that the public markets have been cornered by a group of investment managers small enough to fit at a lunch counter, dedicated to quiescence and inertia. Before index funds, if you wanted to get into the stock market, you had a few choices. You could pick stocks yourself, using a broker to buy and sell them. Nowadays, you can easily buy and sell on your own. Or you could buy into a mutual fund, a collection of investments selected by a vetted manager, promising solid returns in exchange for an annual fee. Then Bogle, the head of a mutual fund company, turned on the industry. He argued that mutual fund fees were exorbitant, that mutual funds generally failed to beat the market, and that fund employees had an obvious conflict of interest. Was their priority to maximize returns for the people who bought into the mutual fund, or to make money for the company? He set up a company called Vanguard, offering a new kind of mutual fund, one that would buy and hold every stock or bond on a major index, and that would devote itself to driving fees as low as possible. Other companies, including Fidelity, State Street, and BlackRock, soon mimicked this strategy, later adding exchange-traded options, or ETFs. The strategy sounds implausible, but it works. Passively managed investment options do not just outperform actively managed ones in terms of both better returns and lower fees, they eat their lunch. Burry's Scion Asset Management at the end of June held $280 million of investments that will profit from rising long-term treasury rates, according to a regulatory filing released last week. That was an increase from $172 million 3 months earlier. Burry made huge, wildly profitable bets against the housing bubble nearly 2 decades ago. In a flurry of tweets in February, Burry warned that the economic reopening and economic stimulus would fan inflation, drawing a parallel between U.S. policies today and Germany's during hyperinflation in the 1920s, the sort of situation that could prompt the Fed to jack up rates. Burry's bearish bond bet is largely in line with the calls of most Wall Street strategists. The median forecast in a Bloomberg survey is for the 10-year yield to end the year at 1.6%, with the most bullish and bearish estimates at 1% and 2% respectively. For example, strategists from Citigroup Global Markets recommend clients position for higher U.S. rates, with the bank seeing 10-year yields climbing to 2% by the end of 2021 on a longer-term economic rebound and Federal Reserve tapering. Traders await the Fed's annual Jackson Hole Symposium, seeking hints from Chairman Jerome Powell on how much COVID-19's resurgence is weighing on economic growth, and whether that sways when the Fed changes course. While the near-term picture is murky, our conviction on the broader macro picture is supportive of higher U.S. 10-year yields. Citigroup strategist Jabaz Mathai in New York wrote in a client note. Morgan Stanley strategist Matthew Hornbach, known for bold calls that have frequently panned out, told his clients this month that he remains confident in his recommendation to bet against 10-year treasuries despite a swoon in yields. The firm expects the yield to end the year at 1.8%, up from 1.26% currently, with the Fed announcing tapering in December. Every aspect of the economic data we look at, from the labor markets to inflation, are all trending to look pretty healthy, which should cause yields to rise over coming months, said Gunit Dhingra, head of U.S. interest rate strategy at Morgan Stanley. And the Delta variant fears have been priced into the market and may have already peaked. We're watching as a potential market mover off Jackson Hole whether Fed Chair Powell has updated his view on Delta, after so far seeming not particularly worried about it. Well, that's it for today's video, guys. Also, we would like to mention that this is not a channel intended specifically to provide financial advice, and we do not ask you to invest in any company. This is merely a channel directed towards bringing educational content to your doorsteps. With that in mind, before you invest in anything, we recommend you do thorough, wide-spectrum research on the topic. And make sure to subscribe and give us a thumbs up. See you next time on Michael Burry Secrets. Bye.